Someone told you that you need 20% down to buy a home, and you believe them. I don't blame you, everybody says it, but it's wrong. And it's literally the #1 reason people are still renting when they don't have to be. I'm Brian Scott Cohen, your mortgage guy, and today we're blowing that myth up for good. So where did the 20% thing even come from? Honestly, it's old, like really old school thinking from when mortgage options were limited and lenders were playing it super conservative. That's not the market we're in anymore. Here's what's happening right now. The average first-time buyer puts down 8%, and there are programs where you can get into a home for 3% down, sometimes 0. So if you've been grinding trying to save up $80,000 or $100,000 before you even think about buying, stop. Take a breath. Let's talk about what you need. So let me walk you through what's actually on the table. First up, conventional loans. If you've got a decent credit score and steady income, you could be looking at just 3% down. On a $400,000 home, that's $12,000, not $80,000, 12. Then there's FHA loans. These are government backed and they were literally designed for people who are earlier in their credit journey. You could qualify with a score as low as 580. There's a reason first-time buyers love these. Now, if you're a veteran or active duty military, listen closely. VA loans, 0 down, no private mortgage insurance. It is one of the most powerful mortgage products that exists, and honestly, it doesn't get used enough. If that's you, please reach out to me directly. USDA loans are also 0 down, and before you tune out thinking that's only for like rural farmland, more zip codes qualify than you'd think. Worth checking. And then the one most people have never even heard of, down payment assistance programs. We're talking grants, low interest loans, sometimes even employer programs. They exist in almost every state. Most buyers just don't know they qualify because nobody told them. That's what your mortgage guy is for. Okay, so here's where people start to panic. PMI, private mortgage insurance. Put less than 20% down on a conventional loan and yeah, you're gonna pay PMI. Usually somewhere between $100 and $200 a month depending on your loan. And I get it, nobody wants an extra line item on their payment. But can I give you a different way to look at it? PMI is not forever. The second you hit 20% equity in your home, gone. You could have it removed. And while you're paying that PMI, you're building equity. You're locking in today's price. You're not writing a rent check every month that builds 0 equity for you. So the real question isn't how do I avoid PMI? The real question is $150 a month worth getting into a home 2 or 3 years sooner? For most people I talk to, absolutely yes. So let's keep it simple. Here's what you need to make this work. Credit score, 580 minimum for FHA, 620 and up for conventional. Higher score, better rate, straightforward. Steady income. Doesn't have to be massive. Lenders want to see consistency. Usually about 2 years of employment history, debt to income ratio. This one trips people up. Basically, your monthly debt payments shouldn't eat up more than 43 to 45% of what you make. I'm going to do a whole video just on this one. It's that important. Some reserves, even going in with a low down payment, lenders want to see you're not completely wiped out. A couple months of mortgage payments and savings goes a long way. That's the list. It's not as scary as people make it sound. You don't need to be wealthy to buy a home. You need to be ready, and that's what I'm here for. I want to take a second and talk about something nobody really thinks through, the cost of waiting. Let's say you decide, you know what, I'm going to keep saving, get to that 20%. Cool. How long does that take? For most people, 2, 3, sometimes 4 more years. And here's what happens in those years. Home prices go up, even modestly, 3, 4% a year. And that $400,000 home is $440,000, $450,000 by the time you're ready. Rents go up, so you're spending more every month with nothing to show for it, and the equity you could have been building, gone. Every month you rent is a month someone else builds equity through your payment. I'm not trying to scare you into anything, but I want you to see the full picture. Because waiting until I have more saved sounds responsible, and sometimes it is, but a lot of the time it's the more expensive choice. Run the numbers, the math usually favors moving sooner. And look, I know what some of you are thinking. Brian, rates are still high. Should I even be buying right now? Here's my honest answer. Rates matter. But they're not the whole story. Right now we're sitting around 6%, give or take. Is that 3%? No. But is it unworkable? Also no. People bought homes at 8%, 10%, 12% rates, and they were fine because they bought a home. And here's the thing about rates. If they drop, you could refinance. You can't go back and buy that same house at today's price once it appreciates. The rate is temporary. The purchase price is locked in the day you close. So if you're sitting there waiting for rates to hit some magic number before you buy, just know that when rates drop, everyone else comes rushing back into the market too, more competition, higher prices. less negotiating power. I've seen this cycle play out more times than I count. The window where buyers have some breathing room doesn't stay open forever. The 20% myth has kept way too many people on the sidelines for way too long. That frustrates me because the options are out there. People just don't know about them. So if you watch this and you're thinking, okay, maybe I could do this, let's find out together. Drop a comment, send me a DM, or hit the link below and let's get you pre-approved. And if you know somebody who keeps saying they can't buy because they don't have enough saved, send them this video. It might change everything for them. I'm Brian Scott Cohen, your mortgage guy. I'll see you in the next one.